Hey everybody, this is Ray from RT Global Trading. Today I want to talk to you about candle range theory. Candle range theory is very important because it identifies the three processes of the stock market. Those processes are accumulation, manipulation, and distribution. This is pretty much how the stock market works. Have you ever gotten into a trade and immediately once you got in the trade, all your money start going down? You got in at the wrong time. It continued to go down. You got panicked out, and then all of a sudden the price shot back up, leaving you more confused than when you started. Well, that was accumulation, manipulation, and distribution. If you can identify those areas, then you'll know exactly when to get in the market and when to get out the market. So I will show you in these three examples the whole accumulation, manipulation, and distribution process. So in this first example, you'll see it's labeled CRH and CRL. CRH is the candle range high, or the highest point that that candle traded at, and then candle range low, or the lowest point where that candle was at. That sets the range for the current sessions. So the next part of that session, you'll see the price go up above, breaking the high from the previous candle, but then come down. That is manipulation. The first candle is accumulation, or the setting of the range. So you have accumulation and then you have manipulation. Again, manipulation is when the price goes above the previous high and then comes back down. That's the area where you probably put your money in and you saw it go down. And then the next part is distribution, or a continuation down to a certain point where it then shoots back up. Well, that certain point is called a liquidity pool. A liquidity pool is when the orders for this area weren't completely taken. And so those traders decided to wait until the price came back down to activate buying at that level. As soon as that price level was reached, they bought in, and then the price is going to go up. So those are your three phases: accumulation, the green candle; this second candle, the red candle, will be your manipulation, and then distribution will be this third candle down to this liquidity pool, where a liquidity grab would be activated because of those buyers who couldn't get in here, and then they're going to drive the price back up. So that is the first example. The second example, you'll see the same setup where you have a CRH, or candle range high, and candle range low. The second candle is a bullish green candle, indicating that price wanted to go up. However, we have a liquidity pool. That liquidity pool has to be reached in order for the price to go up, because we need more buyers in to drive up the price. So once this area has been sufficed, then you'll see manipulation of the price go all the way back up to where at or near that same candle range high. Now we see a candle here that has a high wick to the top and a high wick to the bottom, indicating indecision in the market. We like to call that a spinning top. Again, we don't know which way the direction of the market is going to go. So at this point, you will be watching it, monitoring it, making sure that if it turns around or goes against the trade that you want, you're able to get out very quickly. So the third example, again, same setup: CRH, or candle range high, candle range low, setting the range for the particular session, and a break above that session if it should so happen. So we're at the second red candle, and we see a liquidity pool. So again, price is going to go there, indicating that there are orders that need to be filled at this particular level. Notice that after we fill orders at a particular level, price action always tends to trend up. You see some indecision here, but ultimately, if we're looking at the trend and other indicators that will be taught in my class, we'll notice that the price will take a small bounce down, and then ultimately that price action will go up, because again, the overall trend is going up. A liquidity pool was reached, a liquidity grab was activated, and then we can see the orders from this particular area cause price action to go up. There is a natural pullback here, some profit taking probably, but more than likely the trend is going to continue to the upside. So those are the examples. If you have any more questions, feel free to inbox me. You can catch my YouTube channel at RT Global Trading on YouTube. Thank you for your time.